Yo, what's going on, everybody? It is Wednesday, July 19th. First day that I'm able to do this, and it's not raining at this time. I'm in Florida, and it's like, what is it, like 5 p.m. Eastern time. Usually we have thunderstorms, but today it's okay. It was actually raining in the morning when I got up to work out. So we had a positive day. All three averages were green, not by much. Tenths of a percentage point, but I have to tell you that the fiscal flows have really slowed down, and I think the market is very speculative here. That doesn't mean the bull market is over. I just think that there's a correction coming up. I took some more profits on stocks today. I took profits on Apple. I took profits on Amazon. Both of those stocks I bought much lower during the big pullback last year, so I'm happy about that. I'm raising some cash. Yesterday I took some profits on Walmart. So when the market pulls back in the August through October period, which I expect that it will, I'll have some cash on hand to deploy. That's how you do it, man. That's how you do it. There's still a lot of stocks out there that are really low valuation. The banks still have really low valuation. A lot of there were others. I was looking at them today, but I can't think of them right now off the top of my head. But there's still a lot of them with very low valuation, and I think we're going to see much higher levels in this market. But for right now, I think there's risk because the fiscal flows now, the leading spending flows are the lowest since June 20th. So they've really decelerated, and that's just not, that just makes this rally all the more speculative and vulnerable to a correction, which is no big deal. But what I'm doing here is, like, if you've ever used, if you're driving and you ever use that application Waze, W-A-Z-E, where it tells you, like, there's a traffic jam ahead or there's an accident. That's exactly what I'm doing. I'm just letting you know that ahead there's some hazards, and just to be aware of it. But I'm saying basically in the big picture, like where you're going for your destination, it still looks good. It looks very good. This is just the short term. But if you're a trader, you could take advantage of this. The other thing I did was I bought the dollar. I've been short the dollar for a couple of months. I made nice money on that. Now I'm back long the dollar because I think that this fiscal slowdown will be bullish for the dollar, and the dollar is very oversold. And you notice that all the headlines now, they're talking about how hedge funds are selling the dollar. They were all long at the top. Now they're all selling, and it's just like, I love going against these guys. I feel like it's my duty to go against these guys, and it should be your duty to go against these guys because they're imbeciles and they're sheep and they don't know what they're doing. And it's like, it's like mandatory. It's like your obligation to take their money. Maybe you can't take it in all, but piece by piece, that's fine. Now, the Monitorists, they can't give up on this recession forecast. I just saw another headline on Zero Hedge about how they're talking about the yield curve. Like, how many months, years actually, have we been hearing about the yield curve predicting a recession? I'm the only guy who's been telling you that is inapplicable, okay? Banks just raise their rates, and they're not concerned with the yield curve. Maybe some smaller banks are, but I got JP Morgan, I got Citi, I got Wells Fargo, I got Bank of America. JP Morgan's doing very well. I got some smaller regional banks, and I know I've recommended those, and they haven't done that well recently, but they'll come back. I mean, these are in regions that are growing, they're expanding, they're going to need credit, and they'll be able to supply credit. The other thing you have to understand is when the government is handing out money, as it is right now with these interest income transfers, the non-government, that's us, that's the economy globally, doesn't need as much credit. So if you've been watching things like bank loans and stuff like that. If you're at that level of savviness where you know where to get that information on a weekly basis, and you're getting all nervous because you're seeing bank loans going down, I would tell you not to be concerned about that, because it's a natural trade-off between government spending and private sector credit. And we saw this in the COVID days when we had huge fiscal stimulus and loans collapsed. Why? Because people, they didn't need the loans. They were getting checks from the government. And now it's the same thing with the interest income transfers. They're getting checks, basically getting checks from the government. They're getting interest payments from the government. They don't need to tap credit lines. I mean, you tap credit lines when you need the money. If you don't need the money, I mean, it's this very simple logic. Like, everyone should understand this. Like, and you could see this very clearly on a chart, on a graph, that the debt of the government, the so-called debt, right, the deficit of the government, equals the credit of the non-government. It's an inverse thing to the penny. So if the government is running a deficit of 1.2 trillion, that by definition means there was 1.2 trillion added to the financial balances of the non-government. So, that's a significant amount. And we're up like 500 billion, almost half a trillion over last year at this point in time. So that is a significant injection of financial assets into the non-government. They don't need as much credit. So you can't look at that thing, this is the problem that mainstream economics has, and I've said this so many times. It's a one variable approach. And you can't. You're dealing with a system with multi-variables. And the most important variable, because we're in a dollar-based system and the United States has no external debt, meaning like it doesn't owe any money in foreign currencies. We're in a dollar-based system, which is global, by the way. The most important thing is the fiscal picture. That's why I talk about that every single day. I mean, you don't hear anyone else talking about that. Nobody else is talking about that. Everything is framed in a monetarist perspective. And I've said so many times, it's like a sickness. It's like a psychosis. It's people who don't know what they're talking about. I saw an interview today with this guy, Mohammed El-Arian. It was on CNBC. Actually, a friend of mine sent me this because I don't watch CNBC. But now the monetarists are their excuse for the market rally is that, okay, well, investors think that the Fed is going to cut rates. Well, there's no indication in Fed fund futures of a rate cut, at least not in the near term. And so they have to frame everything. See, they have to explain everything in a monetarist fashion because that's the only thing they understand. And it's funny, we've had this huge rally, okay? There's stocks at all-time highs, like Apple. The German stock market's at an all-time high. We've had this huge stock rally. And they don't get it. They don't understand it because they've been predicting, catastrophe and recession and depression from 10 rate hikes, and the market keeps going up. So they have to come up with some answer as to why the market's going up. But the answer has to be within their understanding. So of course, it has to be a monetarist answer. And the answer they come up with is that, because it's rallying because people think the Fed is going to cut rates. The Fed is not going to cut rates right away, believe me. It's rallying because of what I said going back to last year, that we're going to reach an inflection point where the negative impact of rate hikes, which discount the value of financial assets, is going to be offset by the interest income transfers into the economy, basically checks going out to people and institutions. And I said back in October, we hit the inflection point, and that was exactly the bottom of the stock market. So I don't know what else, I can tell you guys, and I've been telling you this every quarter. I've been alerting you to the buy opportunities. I've been alerting you to the sell opportunities, not just in stocks, but in the dollar and gold and oil. I mean, if you can't make money off of this, then, you know, and that's the other thing that I think I should address. I don't think a lot of you out there really want to make money. I think you want the action. I think you want the excitement. I think you want really, really quick everything to happen, like boom, boom, boom. I see this from my subscriber rolls, which have been going down dramatically this month. And I'm very surprised because this month was, basically a validation of everything I've been saying, basically for the last 9 months. It's a total validation of everything I've been saying for the last 9 months. And people are leaving. So I don't think what they're after is money. I don't think what they're after is profits. I don't think what they're after is wealth accumulation. I think what they're after is, some magical system, and they want the action. It's the action. They want to be in every day and in and out every day. And so I don't provide that, so it's not useful to them. But I mean, money is useful and wealth is useful, and this is what these videos and what I educate people on. There's value in that, but I have to say that I think most people, they don't want that. They think they want that. That's the thing. They think they want that, but they really don't want that. So, and I've lowered the price and everything, but now I'm going to raise the price back up again. So if you have a chance to get back in now, do it, because in a couple of weeks, I'm putting it back up. And when I get out to California, I'm going to be pitching this again to institutions. Maybe out there they have a better open mind about this. But anyway, so yeah, that's it. That's the update for today. And got a couple more days. I'm leaving for LA on Monday. Got a couple more days out there over here in Florida. It's very hot, it's very humid, but I don't mind. I wake up early, I go work out, I run, try to keep in shape, Very important, weightlifting when you get older, man. I always tell elderly people or seniors, the most important thing you can do is lift weights. It's not even about cardio, it's weightlifting. You got to stay strong, because most deaths occur from accidents. People slipping in their tub, breaking a hip, something like that. Not able to get up, not able to walk. You got to maintain your strength. Strength is really, really important. I do cardio too, but I do weights. Strength is very, very important. And your muscles are like little pharmacies, man. When they contract, they secrete enzymes into the body, which are very, very powerful, and they're good for the immune system. They're good for the cardiovascular. All the organs benefit from that. Weights, and you don't have to do heavy, but do as heavy as you can. And I saw a video from Georges St. Pierre, who is a famous MMA fighter. Maybe many of you know who he is. He said, when you party, do a lot, but very little. In other words, infrequently. When you exercise, do a little, but do a lot, means very frequently. So my workouts are only maybe, 25, 30 minutes long. I do weights. And it's very important to maintain your strength, especially when you get older. I'm 66 years old, and I consider myself in pretty good shape. Anyway, that's it for today, folks. Love you all, man. Take care. Bye.